Hi, this is Michael Fisher for savingandinvesting.com, and in this video I'd like to speak briefly about what naked short selling is. And we've talked about short selling in another video, and we've learned that short selling is basically where, for example, a hedge fund borrows a stock from the holder of the shares, the owner of the shares, borrows them through an intermediary, typically like an investment bank, sells them in the market for a given price, say $10, with a view to buying them back at a lower price, for example $8, and benefiting from the decline in price of the stock or any security. So basically short selling involves borrowing a stock, buying it back, ideally at a lower price, although of course if the price rises it would be a higher price and the short sale would have been unprofitable. And for borrowing that stock, there would also be costs involved. So the profit of the short seller would be the difference between where the shares were sold and where they were bought back minus any transaction costs and borrowing costs. In a naked short sale, what happens is that the stock is sold without a borrow being in place. And that is one of the reasons why also it's been focused on quite a bit. In a typical short sale, a borrow has been arranged, so therefore there is a holder of the stock, and for each stock that is held, a short sale can take place. In a naked short sale, there's no borrower arranged, and often the shares are difficult to borrow. And if the shares cannot be found for the borrow, ultimately, then the transaction does not settle, and there's a failure to deliver the shares to the buyer who bought the shares from the naked short seller. In a normal short sale, because the borrow has to be arranged, there are not more shares that can be sold than there are in existence. Basically, a stock is sold when it can be borrowed, i.e. when there's a holder and that holder has made the stock available for a borrow. The main implication of selling shares without a borrow is that theoretically it allows more shares to be sold than there are available for borrow, so that strong selling pressure can be created on the stocks of certain companies or on certain securities, because of the fact that the number of shares is not limited by the amount that can be borrowed or for which their borrow has been arranged. There's some debate on the subject. Traditional short selling is very common, and it's obviously also very commonly done by hedge funds or hedgers in general. And most market observers agree that it's a way for holders of the stock to make money by lending out their shares, and a way for price discovery to be more efficient, i.e. even if a stock is held for the long term because it's part of an index, by lending out the stock and by allowing short sellers to sell the stock, ultimately the best price or the right price or the right price for that particular stock can be more easily found by the buyers and sellers that are able to buy and sell the shares in the market. There's quite a bit of debate around naked short selling, particularly because it allows shares to be sold that aren't available for borrow. In other words, there's no holder of the shares that has made the shares available for borrow. And because of the pressure that can be exerted on a stock or a security without a borrow being in place, naked short selling is illegal in many countries, and it's illegal in the US as well. But it is something that is talked about a lot, and it's sort of a variation of the short selling concept, but a variation that isn't structurally as sound, clearly, because it doesn't involve selling shares that are held by someone and that have been made available to be borrowed, and where the holder of the stock is paid for lending the shares, and where the short seller arguably assists in price discovery and market efficiency.